We talked about what a reporting company was. We always have to begin with that. There are, however, 23 separate categories of exemptions for entities that would otherwise be reporting companies were it not for the exemption. These are listed in the rule, and they're actually in 23 separate enumerated paragraphs. The general idea is that if you're the type of company that is already regulated somehow, so that a government entity somewhere has information about who is actually in control of the company, you're probably going to fit into one of these 23 different exemptions. I want to mention just some of the biggest ones here. The biggest is publicly traded companies. If you are a 34 Act filer, you are exempt. You don't need to worry about it. Why is that? Well, your primary owners are included in your 10K. You don't need to tell the government twice. That's good enough. Next example, a wholly owned subsidiary of an entity that is already exempt. So if you're a publicly traded company, you're exempt. All of your wholly owned subsidiaries also exempt. Easy enough. Same rationale applies. Other exemptions exist for banks, entities that have a money transmitting business license from FinCEN, entities that are registered investment advisors, again, highly regulated entities, insurance producers, insurance companies, public accounting firms that have a license from FINRA to provide public company advice to public accounting advice to public companies. Those are all exempt. Public utilities, exempt. And again, wholly owned subsidiaries of these things, also exempt. The other one that's especially important to notice because it's going to come into play a lot on this slide, I call it grandfathered private businesses. I think FinCEN in its rule called it large private companies. It's rather confusing. Let's go to the next slide. I think I have the definition here. There it is. Yes. So a reporting company that has these three factors will also be exempt. They employ more than 20 employees on a full-time basis in the United States. They have filed federal income tax returns in the US demonstrating more than $5 million in gross receipts in the previous years. And they have a physical office within the United States. Do all of these three things, and you are exempt from filing your report. The trick, however, is that these factors can change. And if you are a business that was exempt under this exemption, and one of these three prongs ceases to apply to you, you will cease to be exempt, and you will immediately start a 30-day clock running by which you must file your first report. So it's going to be quite dangerous giving advice to clients that apply here. Take, for example, your local HVAC installer, okay? They have more than 20 employees. They're big enough that they have more than $5 million in gross receipts on their tax return last year. They have a physical office where people come to work so that law enforcement can knock on the door. There's a downturn in the economy. They have to lay off some of their workers. And as a result, they only have 19 employees. Bang, you just lost the exemption. Under the rule required that we haven't gotten to yet about changes, once you lose that exemption, when that 20th employee is laid off, the clock starts ticking for 30 days, after which time you are late for filing your first beneficial ownership report. So what do? I think for clients that potentially fit this exemption and that are anywhere close to perhaps losing it, either by laying off some employees or perhaps having a bad year, coming in below $5 million, it might be better just to go ahead and file, even though you're exempt, simply to avoid the risk that you might not file on the basis of the exemption, lose it, and then not realize that you lost it and then be late in filing. Also, if you are working through this problem with a client, you need to pay special attention to the definition of physical office. And many of us, work from our homes these days, and your home does not count as a physical office. It has to be a separate building where employees show up to work. If you are the type of company, and I think we all have clients like this, where all of the employees work from home, even if you're over 20 and you're over 5 million, if everybody is virtual working from home, you don't have a physical office because a PO box doesn't count, and you need to check that definition to see. So be very careful applying these exemptions.